Something just broke in the gold market that hasn't happened in over 50 years. And I'm not talking about price action. I'm talking about the actual mechanics of how gold trades, how it's priced, and who controls it. The system that's been in place since 1971 is showing cracks that even the most seasoned traders can't ignore anymore. Let me show you what I mean. Right now, there's a divergence happening between paper gold and physical gold that's wider than anything we've seen in modern history. The COMEX, which is supposed to be the world's benchmark for gold pricing, is trading at prices that make absolutely no sense when you look at what's happening in the physical market. Central banks are paying premiums. Refineries can't keep up with demand. And yet somehow, paper contracts are being used to suppress what should be explosive price discovery. This isn't conspiracy theory territory. This is documented, verifiable market structure breaking down in real time. And the implications for anyone holding dollars, anyone with retirement savings, anyone who thinks their wealth is secure in traditional assets, those implications are staggering. Here's what's actually happening right now. The COMEX has roughly 800,000 ounces of registered gold available for delivery. That's about 25 tons. Sounds like a lot until you realize that central banks alone bought over 1,000 tons last year. China's central bank has been adding to reserves every single month. Poland just announced another major purchase. Singapore, India, Turkey, they're all accumulating. And they're not buying paper contracts. They're demanding physical delivery. Now, do the math. If just 1% of the paper gold contracts on the COMEX demanded physical delivery tomorrow, the entire system would collapse. There isn't enough gold in the vaults to cover even a fraction of the claims. It's fractional reserve banking applied to precious metals, and everyone in the industry knows it. The question isn't if this breaks. The question is when and what triggers it. What makes this particularly dangerous right now is that we're seeing multiple pressure points converge simultaneously. You've got central bank buying at record levels. You've got mine production that's been flat for years, with major producers reporting declining ore grades and rising costs. You've got industrial demand from technology and green energy that's only going up. And you've got a geopolitical environment where countries are actively trying to reduce dollar dependence. Let me give you a specific example of how broken this system is. In November, there was a day when the COMEX saw a flash crash in gold futures. Price dropped nearly 3% in minutes on relatively light volume. But here's the thing. While paper gold was crashing, physical gold dealers couldn't keep inventory. Premiums on coins and bars actually went up. The Shanghai Gold Exchange, which trades physical gold, barely moved. So you had this bizarre situation where the price of gold was falling, but you couldn't actually buy physical gold at that price. That's not a functioning market. That's a broken pricing mechanism being held together by leverage and derivatives. And it's not sustainable. Now, let's talk about what happened in 1971 because there are eerie parallels to today. Back then, the United States was running the Bretton Woods system where the dollar was backed by gold at $35 an ounce, and other currencies were pegged to the dollar. Countries could exchange their dollars for physical gold from U.S. reserves. France, under Charles de Gaulle, started doing exactly that. They sent warships to New York to pick up their gold. Other countries followed. And suddenly the U.S. realized it didn't have enough gold to back all the dollars it had printed. Nixon closed the gold window in August 1971. He said it was temporary. 54 years later, it's still closed. And what happened to gold prices after that? They went from $35 to $850 by 1980. That's a 2,300% increase in less than a decade. Not because gold became more valuable, but because the dollar became less valuable once it lost its anchor to anything real. We're in a similar situation now, except instead of governments demanding gold from the U.S., they're buying it on the open market and refusing to sell it back. They're taking supply out of circulation permanently. And unlike 1971, when the U.S. still had the largest gold reserves in the world, today's gold market is global, fragmented, and increasingly controlled by countries that don't have America's best interests at heart. China is the perfect example. They've been accumulating gold for over a decade, but they're not transparent about it. Official reserves show steady monthly increases, but analysts believe the real number is much higher. Why? Because China produces more gold than any other country, around 370 tons per year, and none of it leaves the country. They're also the world's largest importer of gold. Where's all that gold going? It's not showing up in jewelry demand. It's going into vaults, and it's not coming back out. Russia's doing the same thing. After sanctions hit in 2022, they accelerated gold purchases. They've been selling dollars and euros, buying gold, and settling trade with countries like India and China using gold-backed mechanisms. They're building an alternative to the dollar system, and gold is the foundation. This is where it gets really interesting for the average person, because most people think this is just about countries and central banks. But it's not. When the pricing mechanism for gold breaks down, when physical and paper decouple permanently, the repricing event that follows doesn't just affect governments. It affects every dollar-denominated asset, every retirement account, every savings account, every bond, every stock that's priced in dollars. Think about it this way. If gold is real money, and dollars are just paper backed by confidence, what happens when that confidence erodes? What happens when countries stop accepting dollars for oil, for commodities, for trade settlement? The dollar doesn't go to zero overnight, but it loses purchasing power rapidly, and everything priced in dollars has to adjust. We're already seeing this in subtle ways. Look at the disconnect between official inflation numbers and what people actually experience. The government says inflation is 3%, but housing costs are up 30% in many markets. Food prices are up 25%. Insurance, healthcare, education, all significantly higher. That's currency debasement showing up in real prices, even while the official numbers are manipulated to look manageable. Gold is the canary in the coal mine for this. When gold starts moving in ways that don't make sense based on traditional correlations, when it rallies despite rising interest rates, when it holds value while stocks are also going up, that's telling you something is broken in the underlying monetary system. And here's where this gets personal for anyone with significant retirement savings. Let's say you've spent 30 years building up a 401k or an IRA. You've got $1 million in there, maybe more. You think you're set. But if that $1 million is sitting in stocks and bonds, and those are priced in a currency that's losing purchasing power, you're not actually preserving wealth. You're watching it erode in real terms, even if the nominal number stays the same or goes up. This is why, and I'm just going to mention this briefly because it's relevant, a lot of people are looking at gold IRAs right now. It's a way to get physical gold into a retirement account without triggering taxes or penalties. I put together a free guide on how this works. It's in the description below. If you've got $100,000 or more in retirement savings, it's worth understanding how this option works, especially given what's happening in the gold market right now. Not saying it's right for everyone, but it's worth knowing about. Anyway, back to the system failure. Let's talk about what actually triggers a breakdown in the COMEX. There are a few scenarios, and they're all becoming more likely. Scenario 1. A major commercial bank or hedge fund that's short gold futures gets caught in a squeeze and can't deliver. This almost happened in March 2020 when the gold futures market seized up during the COVID panic. Spreads between futures and physical blew out to $70 an ounce. The CME had to step in and change delivery rules to prevent a default. That was a warning shot. Scenario 2. A sovereign nation or group of nations demands physical delivery on a scale that exceeds available supply. Imagine if China decided to take delivery on even 10% of their paper gold positions. The COMEX couldn't handle it. They'd have to cash settle, which would immediately destroy confidence in paper gold as a pricing mechanism. Scenario 3. A geopolitical event that makes physical gold impossible to transport or deliver. Think about what happened with Russian assets after sanctions. Overnight, billions in dollar-denominated assets were frozen. Now imagine that happening with gold shipments. If you can't physically move gold between jurisdictions, the paper market becomes meaningless. Any of these scenarios leads to the same outcome. Paper and physical decouple, price discovery moves to physical markets in Asia and the Middle East, and Western financial institutions lose control of gold pricing. That's the system failure. And it's not a matter of if, it's a matter of when. Now, let's look at what happened in 1980, because that's the other historical parallel everyone should understand. Gold hit $850 in January 1980. Adjusted for inflation, that's over $3,000 in today's dollars. But here's what most people don't know about that peak. It wasn't just about inflation. It was about a loss of confidence in the entire financial system. In the late 1970s, inflation was running at 13%. Interest rates hit 20%. The dollar was collapsing against other currencies. There was an energy crisis. There was geopolitical chaos with Iran and the Soviet invasion of Afghanistan. People genuinely believed the system was breaking down, and they piled into gold as the only asset that couldn't be printed or devalued by governments. What ended that gold bull market? Paul Volcker jacked interest rates up to 20%, deliberately crashed the economy into a severe recession, and restored confidence in the dollar by showing the Fed was willing to do whatever it took to stop inflation. It worked, but it required economic pain that would be politically impossible today. Fast forward to now. We've got inflation that's structurally higher than official numbers suggest. We've got interest rates that can't go much higher without breaking the government's ability to service its debt. We've got geopolitical tensions that are worse than any time since the Cold War, and we've got a Federal Reserve that's trapped between fighting inflation and preventing a financial crisis. The difference between now and 1980 is that back then, the U.S. could afford to raise rates because government debt was manageable. Today, the U.S. has $36 trillion in debt. Every 1% increase in interest rates adds $360 billion to annual interest payments. The government literally cannot afford the Volcker solution, which means they can't stop currency debasement, which means gold's role as a monetary anchor becomes more important, not less. Here's another piece of the puzzle that most people miss. The gold market isn't just about investment demand. Industrial demand for gold is rising because of technology. Electric vehicles use gold in their electronics. 5G infrastructure uses gold. Renewable energy systems use gold. These aren't discretionary uses. You can't build a solar panel or a smartphone without gold. So even if investment demand stayed flat, industrial demand alone would create supply pressure. And supply isn't keeping up. Global mine production peaked around 2018 and has been flat or declining since. The easy gold has been mined. New discoveries are rare. Existing mines are seeing declining ore grades, which means they have to process more rock to get the same amount of gold. Costs are rising, and there's a lag time of 10 to 15 years between discovering a new deposit and bringing it into production. So you've got demand rising from multiple sources: central banks, investors, industry, and supply that's constrained. In any normal market, price would rise to balance supply and demand. But in the gold market, price is suppressed by paper contracts that have no connection to physical reality. That's the distortion. And distortion's always correct, usually violently. Let me give you another example of how this plays out in practice. In 2011, gold hit $1,900 an ounce. Everyone thought it was going to $2,500 or $3,000. Instead, it crashed and spent the next 8 years in a bear market. Why? Because central banks convinced everyone they had inflation under control. They printed trillions in quantitative easing, but inflation stayed low because that money went into financial assets, not the real economy. So gold, which is an inflation hedge, fell out of favor. But here's what changed. Starting around 2019, and accelerating after 2020, that printed money started leaking into the real economy. Inflation came back. And this time, central banks can't stop it without crashing the system. So gold started rising again, and it's been in a bull market ever since. We're now above $2,600, and the fundamentals suggest we're nowhere near the top. What's different about this cycle is that it's not just retail investors buying gold. It's central banks, it's sovereign wealth funds, it's institutional money that understands the endgame of unlimited money printing. These are smart, well-informed players who are voting with their capital. And they're not buying paper gold. They're buying physical and taking delivery. This creates a feedback loop. As more physical gold gets locked away in central bank vaults, the available supply for the commercial market shrinks. That puts pressure on the COMEX and LBMA to deliver on their paper contracts. As that pressure builds, the risk of a default or a cash settlement increases. And if that happens, confidence in paper gold evaporates and price discovery moves entirely to physical markets. When that happens, and I believe it's a when, not an if, the repricing of gold won't be gradual. It'll be a step function. One day gold is $2,600. The next day it's $5,000 because the paper market broke and physical is the only real price. And if you're holding paper gold, ETFs, futures, mining stocks, you might not participate in that repricing. You might get cash settled at the old price, while physical gold trades at the new price. That's the system failure. That's the alert. And that's why anyone who understands what's happening is moving into physical gold now, before the break happens. Now, let's talk about what this means for the average person's wealth. Most people have their wealth in 3 places: real estate, stocks, and bonds. All 3 are priced in dollars. All 3 assume the dollar maintains its purchasing power. And all 3 are vulnerable if the dollar loses its status as the world's reserve currency. Real estate seems safe because it's a hard asset. But real estate is also leveraged, illiquid, and subject to property taxes that rise with inflation. If the dollar loses half its value, Your house might double in nominal price, but you haven't gained any real wealth. You've just kept pace with currency debasement, and if you need to sell quickly, you're at the mercy of market conditions and buyer financing. Stocks are even more vulnerable. Stock prices are based on future earnings discounted back to present value. If the discount rate changes because of currency instability, stock valuations collapse. We saw this in the 1970s. Stocks went nowhere for a decade in nominal terms and lost massive value in real terms. The Dow Jones was at 1,000 in 1966 and still at 1,000 in 1982, but adjusted for inflation, it lost 70% of its value. Bonds are the worst. If you're holding a 30-year Treasury bond paying 4% and inflation runs at 6% for the next decade, you're losing 2% per year in real terms. You get your principal back in 30 years, but it's worth half what it was when you bought the bond. That's a guaranteed loss of purchasing power. Gold doesn't have these vulnerabilities. It's not leveraged. It's not someone else's liability. It doesn't depend on a government's promise or a company's earnings. It's just gold. And throughout history, gold has maintained its purchasing power across centuries, across empires, across currency regimes. An ounce of gold bought a fine suit in Roman times. It buys a fine suit today. That's not because gold went up. It's because gold stayed constant while currencies came and went. The dollar has lost 98% of its value since the Federal Reserve was created in 1913. Gold hasn't lost anything. It's the measuring stick that shows you how much the currency has been debased. This is why central banks hold gold. It's not because they're stupid or old-fashioned. It's because they understand that gold is the ultimate reserve asset. When everything else fails, when currencies collapse, when bonds default, when stocks crash, gold is still gold. And the countries that have gold have options. The countries that don't are at the mercy of whoever controls the reserve currency. Right now, that's the United States. But the U.S. is losing that privilege through its own actions. Weaponizing the dollar through sanctions, printing unlimited amounts to fund deficits, running trade imbalances that flood the world with dollars. These policies are destroying the dollar's credibility as a neutral reserve asset, and countries are responding by diversifying into gold. This is the context for the system failure. It's not just about the COMEX running out of gold. It's about the entire dollar-based financial system losing legitimacy. And gold is the alternative that's been waiting in the wings for 5,000 years. So what do you do with this information? First, understand that this isn't a short-term trade. This is a structural shift that's going to play out over years, maybe decades. You're not trying to time the market. You're trying to position yourself on the right side of a monetary regime change. Second, recognize that physical gold is different from paper gold. If you own gold ETFs or mining stocks, you have exposure to gold prices, but you don't have the protection that physical gold provides. In a real crisis, paper claims get settled in cash. Physical gold is the asset itself. Third, think about allocation. You don't need to go all in on gold. But having 10% to 20% of your liquid net worth in physical gold makes sense as insurance against currency debasement and system failure. It's not about getting rich. It's about preserving what you've already built. And fourth, understand the timeline. This system failure isn't happening tomorrow, but it's happening. Every month that central banks buy another 50 or 100 tons of gold, every quarter that mine production stays flat, every geopolitical event that undermines dollar confidence, we get closer to the breaking point. The smart money isn't waiting for the break to happen. They're positioning now, while physical gold is still available at prices that reflect the paper market. Once the paper market breaks, physical gold will trade at a significant premium, if you can find it at all. This is the alert. The system that's priced gold for the last 50 years is failing. The divergence between paper and physical is widening. The pressure on the COMEX is building, and the countries that understand what's coming are accumulating as fast as they can. You can ignore this and hope the system holds together. Or you can take action now and protect yourself before the repricing happens. The choice is yours, but the window is closing. When this breaks, it's going to break fast, and there won't be time to react. The people who are prepared will preserve their wealth. The people who aren't will watch their purchasing power evaporate in real time. That's the system failure. That's the alert. And that's why gold just flashed a warning that anyone paying attention cannot afford to ignore.